SARP was set to expire for new arrivals at the end of 2025. But Budget 2026 extended it, all the way to 2030. If you qualify and you haven't applied, you are leaving serious money on the table. This video shows you exactly what to do. You work hard in Ireland. You pay your income tax, your USC, your PRSI. For higher earners, the combined rate of income tax, USC, and PRSI reaches about 52% on every extra euro you earn. That is more than half your next pay rise gone before you touch it. And most workers, including well-paid expats assigned to Ireland, have no idea that the law gives them a direct route to cut that bill dramatically. SARP is a tax relief for employees assigned to work in Ireland by their overseas employer. It provides an income tax exemption on 30% of employment income above a qualifying threshold. Your employer probably knows about it. But if they haven't filed the paperwork for you, you are paying thousands more than you legally have to. The Special Assignee Relief Program is administered by the Irish Revenue Commissioners and was originally introduced under Section 825C of the Taxes Consolidation Act 1997. SARP relief applies to assignments during any of the tax years 2012 to 2030. Qualifying individuals are entitled to exclude 30% of employment earnings over €125,000 from the charge to Irish tax. There is a maximum income limit of €1 million upon which relief may be claimed. Separately, pension contributions give every Irish worker, not just expats, a second powerful legal weapon. Relief is given as a deduction from your income before tax is calculated. It reduces your income tax, and it works at your highest marginal rate. Here is what the 2026 rules actually mean in cash. 2 income tax rates apply, 20% on income up to your standard rate cutoff point and 40% above it. For a single person, the cutoff is €44,000. On a €200,000 salary under SARP, the exemption applies to €75,000, that is €200,000 minus €125,000, saving €9,000 in income tax at the 40% rate. On pensions, revenue sets age-related limits on the percentage of gross earnings, capped at €115,000, that qualify for tax relief. Under 30 it is 15%, age 30 to 39 it is 20%, age 40 to 49 it is 25%, age 50 to 54 it is 30%, age 55 to 59 it is 35%. And age 60 and over it is 40%. If you pay tax at 40%, every €100 you contribute costs only €60 after relief. Stack SARP and pension relief together, and you could legally reduce a very large tax bill by tens of thousands of euros a year. 3 things you can do today. First, check your SARP eligibility right now. You must be assigned by a relevant employer to work in Ireland for that employer or an associated company. You must not have been Irish tax resident in the 5 tax years preceding your arrival year. Go to revenue.ie and search SARP. The official conditions page was updated in January 2026. Second, if you qualify, tell your employer immediately. The employer must certify to the Revenue Commissioners, within 90 days of the date the individual arrives in the state, that the qualifying conditions have been met. Missing that deadline costs you a full year of relief. Third, review your pension contributions at myaccount.revenue.ie. Pension contributions qualify for tax relief at your marginal, that is your highest, rate of income tax. Check your age band, check your earnings, and top up before October 31st. We have written the full breakdown of every figure in this video, the SARP conditions, the pension tables, the exact USC bands for 2026. Read it and use the free salary calculator at EuroDuty.eu. The link is in the description.